Hello, everyone, and welcome to another wonderful day of life here in Southern California. Not too sunny, not too hot, but we'll take it after this heat wave. Well, my name is Sadie Uribe, and I'm the Community Engagement Specialist for Los Angeles Regional SBDC. The SBDC is a national program with over 1,000 locations across the country, helping to stimulate economic growth through business advising and development. We offer no-cost services to the local businesses through funding provided by the U.S. Small Business Administration, SBA, and from the California Governor's Office of Business and Economic Development, GoBiz. The Los Angeles Regional Small Business Development Center Network serves small businesses throughout Los Angeles, Santa Barbara, and Ventura counties. We offer no-cost business advising, meaning you can meet one-on-one via phone or Zoom to address your specific needs and challenges. And we also offer virtual training, such as this amazing webinar, comprehensive workshops to help adapt and grow your business. But without much ado, let's say hello to our gents over here, Mike and GB. What are we doing today?
Wow, I feel like a celebrity. That was a great introduction. You would be a great MC, Sadie, or right? you already are.
Hi-oh!
How are you, Mike?
I'm doing well, GB. And how was your vacation to Hawaii? It wasn't a vacation, it was a work trip, right?
Well, I always travel for work. Yeah, but I did this time around, took my family. So there was mostly work and some vacation. So mostly it was vacation for them. My son told me I need a vacation. I'm like, dude, you're 7. From what? But apparently he needed a vacation.
Well, welcome back. What are we going to be discussing, GB?
So today we're going to talk about Schedule C and its implications if you make it a 0 or a negative Schedule C. So that's what we're talking about today, the short-term and the long-term repercussions of a 0 or a negative Schedule C.
Before we get into that, a couple housekeeping points. A, please put all questions into the Q&A. B, please keep the questions on topic. C, EIDL loans are coming due for first payments. There's a process that you have to follow in order to make those payments. You have to go to a capital access system, set up an account on pay.gov. I put a link into the chat room for an article that explains all this. And if you don't understand it, if you need help, set up an appointment, as always, with an SBDC advisor, and we'll be able to help you with the setup of your account to pay your EIDL loan. Want to add anything to that, GB?
No, I think you covered it all.
Okay, please go forward then.
Perfect. I'm going to do my screen share. Can you see my screen, Mike?
Yes, we have it.
Perfect. Excellent. So anytime, most of the time, when I work with small business owners, they come to me with the goal of, hey, GB, I made so much money. Can you make it 0 so I don't have to pay anything in taxes? Or better yet, can you make it negative so that I don't have to pay taxes on my W-2 income or my spouse's W-2 income? Well, I cannot do that because I can only reflect what your business decisions yielded. But there are things we can do, such as bonus depreciation and other tactics by which we can lower your taxable income. However, that does come at an opportunity cost. And the topic of today is what those opportunity costs are if you go with a 0 or a negative Schedule C from your business year after year after year. Now, keep one thing in mind. What I'm not going to talk about today are the hobby loss limitations. You may have an LLC that is filing a Schedule C, or you may be an independent contractor, you may be an Uber driver, you may be a 1099 worker. Any of those situations may lead to a Schedule C. And if you do end up legitimately with a negative or a 0 Schedule C, there is always the risk of your business being classified as a hobby, which means that your loss limitations from that so-called hobby may have tax consequences for you. So I'm not talking about that today. We're talking beyond that, assuming you are not subject to the hobby loss limitations, what a 0 or negative Schedule C may cost you in the long run. So the basics, you pay, I pay, anybody who has a Schedule C would pay taxes based upon what is line 31. Your line 1, your gross income, maybe $1 million, maybe $10,000, maybe $1,000, maybe whatever. That is, generally speaking, for income tax purposes, irrelevant because it takes money to make money. So IRS will have you on Schedule C tell them what did it cost you to make that line 1 on your Schedule C. And that, after all the deductions on line 31, that is your taxable income. Now, that income is subject to income taxes, both on the federal and the state level, but even beyond that, because let's say if your line 31 is $12,000 and you are a single tax filer, your income tax will be 0. Why? Because the standard deduction is $12,000 and some change. But even though you may not pay anything in income taxes, you have to pay self-employment tax, which pays for Social Security and Medicare in the long run. And that is usually 15.3%, which is 12.4% for Social Security and 2.9% for Medicare. Now, if your line 31 happens to be $200,000 or more, of course, you may owe income taxes. You may or may not, it depends upon other factors, but you will owe an additional 0.9% in Medicare, because a lot of people want Medicare for all. And if you happen to be making $200,000 or more, they want you to burden that subsidy for other people. So you may end up with 16% or more in Social Security and Medicare taxes, even long before you pay any income taxes. And this is why I tend to remind our attendees that 60% of Americans pay nothing in income taxes. And that is because they are still subject to, these are mostly insurance premiums. Before I go on, Mike, does this slide, the first half, make sense of how line 31 may lead to self-employment taxes, which may or may not lead to income taxes down the line?
Yes, it makes sense to me.
Perfect.
For those who are unfamiliar with self-employment tax, keep in mind that when you work for yourself, you have to pay everything into Social Security and Medicare. Whereas if you're working for someone else, your employer will be paying half of those taxes.
Absolutely. Absolutely. I'm glad you bring it up, because you may be running a small business, Schedule C or an LLC, disregarded for tax purposes, but you may have an employee or two. And if that happens, you have to pay half of their Social Security and half of their Medicare tax. And they will pay the other half from their W-2, their paycheck, as you pay them every week or every 2 weeks or bi-monthly, whatever schedule you may have on them. But after everything is said and done, whatever is on line 31 of your Schedule C, you will pay your own employer and employee, because you're self-employed, employer and employee share of 15.3%. So if you end up with a $10,000 net income, you will end up paying $1,500 in taxes, give or take, approximately. Because I say give or take because there are certain small limitations, so using round numbers. So you may owe nothing in income taxes, but you may owe $1,500 and change in self-employment taxes. And these are basically insurance premiums. I remind my clients and my attendees from time to time that 2/3, actually over 2/3 of the entire US budget goes towards paying Social Security and Medicare benefits. This is why Schedule C tends to be at a higher risk of an audit, because self-employment taxes and payroll taxes are considered trust fund taxes. People who are retired today are relying on you to pay for their benefits. Just like when you were retired, if Social Security is still functioning, you will expect the workers in the future to pay for your benefits once you choose to hang up your shingle. So these are trust fund taxes, and the current generation has to pay for the past generation. So if you are a Schedule C and you artificially deflate your taxable income on line 31, it can cause a heap of trouble for you, because you may or may not have income tax liability, but you do have self-employment tax liability, and the US government relies on your efforts to pay the benefits of current retirees. So keep that in mind. If your employer and employee payroll taxes on Schedule C, and whatever's on line 31 is your responsibility to pay for it.
And GB,
Yes,
so
sir.
Schedule C filers are sole proprietors of those who are single member LLCs. For those who not everybody may not be aware of that. We have a couple of questions
Correct.
already.
Yes, go for it. Shoot, before I go on.
One wants to know, what if she's already collecting Social Security retirement? I don't know.
Good question. We'll come
Yeah.
to that in one of my slides briefly. So good question. Please hold on to that question for a few more minutes.
One other question. Dell is a sole proprietor. He's taking a 1099 from the money he makes. Should he choose the option to hold additional money for the taxes?
Generally speaking, yes, you can opt for your 1099 issuer to withhold taxes. They will just withhold taxes. When you're working under W-2, your employer has to itemize on your paycheck and then eventually on your W-2. I have withheld so much for income taxes, state and federal, so much for disability, Social Security, Medicare. But when you're 1099, if you tell the issuer of the 1099 to you to withhold taxes, they will just withhold taxes at whatever percentage you may tell them. The most common is usually 20%. And that has to be separate for the federal and the state withholding. And then at the end of the year, when you do your taxes or have somebody else do taxes for you, you will owe taxes on your 1040. And that's where you will itemize what amount goes where. The 1099 issuer will not do that itemization for you. If you are a W-2 worker, they are required to do so, but not if you're 1099.
We're also on a pay-as-you-go system. You're supposed to be filing quarterly estimated tax payments
Exactly.
and returns. But
This
please
is
go
why
ahead.
it's important to do your bookkeeping on a monthly, at the very least quarterly basis, so that you know what is your profit or loss for the quarter that just ended. For example, we had a quarter that just ended in September. So you are supposed to make payments for that by December for California and by January for IRS. We do live in a pay-as-you-go system. Any other questions, Mike, before we go on?
Dell wants to know, will the tax, I think he's referring to the taxes we withheld by a W-2, a 1099 issuer. Will they send those taxes withheld on to the IRS?
Repeat that question one more time, please.
Dell wants to know, his question is, so will they send it to the IRS on your behalf? I'm assuming what he's asking is if a W-2 issuer is withholding the monies for Dell, will they send it on automatically to the IRS?
They're supposed to. They're supposed to send it to the IRS. If they're withholding it for you and they don't pay, then they are in a heap of trouble because, again, trust fund taxes. If you don't pay income taxes, the worst they can do is go after your money. You don't pay somebody's payroll or self-employment taxes, you're looking at prison term should the government choose to. So sales tax, payroll tax, these are trust fund taxes, and the violation of that is far more severe than income tax evasion. So yes, if they withhold taxes that you, and this is why actually, if somebody issues you a 1099, IRS, because IRS doesn't know, right? The person issuing you the check and giving you a 1099 has no idea what you're doing with the money. You could be buying a Tesla and taking tax credits and tax deductions, or you may be going on a vacation to Hawaii. So all of that is considered income taxes from their point of view. So, but even then they could be in trouble. And this is where IRS may or may not get involved. And this is why a lot of people usually opt to pay estimated taxes, because if somebody withholds taxes for you, chances are IRS is not going to go after them. They will. I'm actually dealing with a similar close issue, and IRS basically said, hey, give us our cut and have your client sue the person in a civil court to seek remedy. We're not going to get involved. So this is where it is usually better to get the money, do your own bookkeeping, and pay your own estimated taxes, as opposed to relying on somebody else's financial acumen and financial discipline to take care of your responsibilities. Anything else, Mike?
No, please continue.
Perfect. So Social Security and Medicare taxes, there are certain limits. You you have to pay Social Security taxes for at $147,000. So if you make $500,000, you only pay Social Security taxes on $147,000. Now this number is adjusted every year for inflation. So don't just think 147 is set in stone. It is adjusted every year, but that's the max. However, there is no max on Medicare. So just like if you are a single individual making $200,000 or more, you're going to pay additional Medicare taxes. And that's on top of the 2.9% already. If you are married or some other status, then up to anything over $250,000, you are going to pay additional Medicare taxes. Why? Because Medicare is expensive. Medical care in this country is expensive. So there is no cap on it. Social Security benefits are limited. So we'll talk briefly about that in a few slides, that depending upon how much money you make in your lifetime will determine how much Social Security check you may receive in retirement, again, depending upon when you choose to retire. But Medicare, God forbid somebody has a kidney disease, plus they have a heart failure, plus they have amputation. I mean, unfortunately, my dad went through all of that stuff. There is no cap on medical care. We value human life, and we spend billions of dollars every year, trillions of dollars in sustaining life. So this is why there is no cap on Medicare. You make $1 million earned income, you will pay Medicare on all of that, 2.9% plus another 0.9% on top of that. Now, to be eligible in retirement for Social Security full benefit and the Medicare full benefit, you must earn 40 credits in a lifetime minimum. How do you earn 40 credits? Well, you are eligible to earn 4 credits per year. And even that number changes. So for example, in 2021, you must have earned a minimum of $1,510 in earned income to be eligible for 1 credit on line 31. So if you made nothing, or if you have a negative Schedule C, guess how many credits you earned? 0. If you made $1,500, guess how many credits you have earned for 2021? 0. If you earned $1,510 on line 31 after all your deductions, depreciation, home office, all of that stuff, you earned 1 credit. If to earn full 4 credits, 1,510 times 4 is $6,040, which means you must have earned at least, after everything is said and done, $6,040, which means your self-employment tax will be around what? I'm not able to do simple math right now. So $6,000 times 15%, about $900. You will pay at least $900 in premium to the US government to earn 4 credits to be eligible eventually to earn Social Security income and Medicare. Now, this is why I'm doing this presentation today. Without fail, every single year, there are many people sitting in my office crying because they want to retire. They're like, all right, GB, life didn't pan out the way I expected, but hey, at least I will be able to collect Social Security, something better than nothing. And at least I'll get the Medicare. No, you're not. I'm sorry to tell you, you did not earn enough money. You did not earn on your Schedule C in your lifetime 40 credits. You may have limited benefits, but in some cases, you will have no benefits because every year for last couple of years, many years, you have always filed a 0 or a negative Schedule C. So this is why it's important. Social Security and Medicare is not guaranteed to everyone. You have to pay into the system to be eligible. And if you're not, you better have a plan B or a plan C to be able to sustain yourself if all you have done in your entire life is work for yourself. Now, keep in mind, there is a possibility that before you embarked on working for yourself, maybe you had a job. Maybe that job paid you X amount of money. And because of that, you may have earned 40 credits already because maybe you had a job that paid you minimum wage. And because remember, the 1510 is adjusted. A couple of years ago, that was down to maybe $300 for each credit. So don't live in fear. There have been an opportunity. Maybe you did work for somebody and somebody issued you a W-2 and you made enough money to get credits. But if you're like me, where you have always been self-employed in one capacity or another, never held a job since age 16, you better pay into the system on your own. Otherwise, you may be in a big surprise. God forbid if life gives you lemons. You will not have tools to make lemonade. So this is why I'm doing this presentation. If you had a job, great. You may have that safety net, however limited, but if you've always been working on your own, or if you're young right now, maybe you are 21, maybe you are 31, and you have been self-employed since college or since high school, and you've always done a negative or a zero Schedule C, you may want to think long and hard in how much you want to pay into the system or have plan B or C to sustain yourself should in retirement, or we'll talk about that, should at a younger age, you may have to opt into the system because life threw you a curveball. Before I go on, any questions, comments, or any insight you would like to share, Mike?
No, excellent points. Please continue.
Thank you, sir.
There are those who are on government payrolls that would get pensions. It's
Yes.
different when you're on government payroll.
Exactly.
Just keep that in mind.
Yes. So what's the benefit? If you are a top earner for your entire life, maybe in your own business or you had a job, the maximum benefit for 2022 is $3,345 per month. So if you have been a top earner and you did nothing in your life to save for yourself, or life threw you some lemons or curveball or dealt you a bad hand, life happens, unfortunately. Life is not fair. We all know that. Good things happen to bad people, bad things happen to good people. So the maximum benefit for you may be $3,345. You may have a spouse who also had a job or self-employment where you fully paid into the system, you're a high income earners. Well, great. You're making almost $7,000 per month in Social Security benefits. Maybe not bad, not great, but $7,000 in Social Security benefits, almost inflation adjusted periodically, not bad. You may be okay. But if you didn't, maybe you've been filing negative or zero Schedule Cs. And if you only paid into the system for 11 years, guess what? Your minimum benefit may be only $46 or $45.50 per month. Can't do much, can't even buy a tank of gas nowadays with that kind of money. If you work for 30 years and you paid somewhat into the system, your minimum benefit may be $950.80 in 2022. Again, if this is all you got when you reach the end of your working years, either by choice or by a medical or some other condition, $950.80 doesn't go very far in Southern California. I think I've mentioned before, a middle-class family, to actually a family of four, to live a decent middle-class lifestyle, California averages you need, as a family of four, you should earn $270,000 a year. That's only 5% of California households. So $270,000 a year, $950 is less than 10 grand a year. It's going to be tough. So this is why Plan B and Plan C should come into play if you are thinking of having a zero or negative Schedule C. So this is why I'm doing this presentation. Mike, I'm going to take a quick break. My computer's acting up, so give me just about 30 seconds. I'll be right back.
Go ahead and take the break. While we're doing that, are there any questions thus far that anyone has regarding what GB has presented? So put them in the Q&A.
That was a quick
You
fix,
good, GB?
sorry. Yes,
Okay.
sir, I'm back. So if you wait, let's say you are fully funding your government benefit plan, because this is a government benefit plan. You may still have your other plans, IRA, 401k, whatever it may be. But if you are relying on this, and a lot of financial planners do account Social Security benefits for retirement beyond whatever else you're doing, crypto, real estate, whatever it may be. If you wait till full retirement and you are still earning income, you will have no reduction in your benefit. So if you are eligible to earn $45 per month or $950 a month or $3,345 per month, and you wait till full retirement, or once you reach full retirement, which really varies on when you're born in the 50s or 60s or late 60s, Social Security has a whole table on their website, there'll be no reduction in benefit. But if you haven't reached full retirement age, which for most of us born in the late 60s or later, I think it's a full retirement age is 67, I believe. If you haven't reached, if you start taking benefits at age 60 or 62 or 65, for every $2 that you earned over $19,560, your Social Security benefit will be reduced by $1. So if you earn $19,000 while you're collecting Social Security and you're below the full retirement age, you will get your full benefit. There will be income tax, there could be income tax consequences. We'll talk about that in a few minutes. But as far as your benefits are concerned, you don't have to worry about it. But if you end up earning $20,000, well, now your benefits will go down. So let's say 20,000 is $440 over that. So your benefit will go down by $220 because for every $2 over 19,560, $1 in benefit reduction. Why? Because you're making money. The government rather pay somebody who is not earning money by choice or because of some medical or some other economic factor. So actually, before I go on, any questions on that? Especially, I know somebody had a question related to that a few minutes ago.
Raymond asked, what if he works for his S corp? Does this still apply? You don't see a Schedule C on my tax return. So Raymond,
If you're sorry,
go ahead. No, go ahead.
If you're S corp, you're not self-employed. If you're S corp, whether you're an LLC tax as an S corp, you are maybe a corporation tax as an S corp. If you are supposed to take a reasonable compensation. IRS actually frowns upon people who have S corps and they issue themselves 1099 from the S corp. You're not supposed to do that. You're supposed to be a W-2 employee of your S corp. So that's a little bit different because if you're giving yourself a W-2, you cannot zero out your W-2, but there's a possibility that you may be taking a W-2 from your S corp, but your spouse may be taking a Schedule C. And so there could be tax and benefit implications for one or both of you. So right now I'm sticking to Schedule C because a lot of people get LLCs and they keep them disregarded, and there can be benefit and tax implications because of that. But you're not self-employed if you have a S corporation tax election. Anything else, sir?
No, please continue.
Perfect. So how are Social Security benefits calculated? Well, they look at, there's a whole math that goes beyond it, but basically they're looking at your 35 highest earning years. Most people start working at the age of 16, if not sooner. Most people work for 50 years on average up until the age of 65, 66, 70, whatever that age may be. So you have half a century of potential work ahead of you. Social Security will say, you know what, maybe you were a high school dropout, maybe you went to college, but you started off slow. Maybe you wanted a student debt forgiveness, so you worked 10 years for a nonprofit or for the military, you did Peace Corps, whatever you did. Of those potentially 50 years, they look at your highest 35 years of earnings. And they use AMI, average income monthly index to figure out, okay, what was your average income over your 35 highest earning years? And then the goal is to replace about 27 to 40% of your average income. Why 27 to 40%? Maybe you were a lawyer who never incorporated, never did the S corp election, never did partnership. You were just a freelance lawyer and you made maybe $200,000 a year. Should you get more benefit than somebody so by percentage, your income, your Social Security benefit will be lower. The average Social Security benefit tends to be around a third. that whatever are your highest 35 earning years, you may get about a third in Social Security benefit in retirement. But the range is anywhere from 27 to 40%. And this is why if you've been filing a 0 or a negative, the average may drop. You may have 10 years of positive Schedule C, but now you have 25 years of negative or 0 Schedule C. Your average will drop significantly, which means you will get maybe $45, maybe $950 per month if you were to retire today. And people have to make lifestyle choices, which state, which country they may retire in, because $950 a month will not go far in Southern California, may not even go far in Alabama. Sometimes people choose to live, and if they don't have enough credits, we'll talk about Medicare in a few minutes, that can have an impact on you as well down the line. So this is why income tax planning also revolves around retirement planning, because one day you may choose, or life may make choice for you to retire, and that you can no longer work, or you may no longer want to work, or the industry you're in may not exist anymore, right? I mean, my mentor used to joke that back in the days, rich people had cars and poor people had horses. And today, poor people have cars and only rich people have horses. Why? Because the lifestyle, the macroeconomic issues have changed over the years. So whatever we're doing today, the market may not want to employ us 5 years, 10 years, 20 years from now. So this is why retirement planning is also prominent, and the goal should never be just a 0 Schedule C or a negative Schedule C, unless you have a plan B or plan C in mind, which I'll briefly touch upon. So before I go to the next slide, any questions, comments, or any feedback from you, Mike?
No, this is a great job. Please continue.
Thank you, sir. So 0 Schedule C. What are the other implications? Well, beyond the Social Security benefit, there's also the Medicare. I mean, there's always a cry from the population, right? Let's do Medicare for all. Well, medical care around the world, and especially in this country, is not cheap. So not only if you file negative or a 0 Schedule C, not only will it have Social Security impact, it will also have Medicare. So if you have, as many of you may know, and if you don't, I hope over time you will educate yourself, Medicare has multiple parts to it. Part A, Part B, Part C, Part D, and each has its own benefits that Medicare promises. But if you have 29 or fewer credits in your lifetime, because you have never worked for anybody and you filed negative or 0 Schedule C, and you only got 29 credits, Medicare will cost you in retirement $780 per month. That's a lot of money. That's more than what a lot of people pay under Cover California under the Bronze Plan. So if you don't plan for this and you reach the age of 65 and you want to collect Medicare, the US government will give you Medicare, but they will send you a bill every single month for $780. Or worse, going back to the previous slide, maybe your Social Security benefit is only $950. They will deduct this $780 from that $950, and whatever few bucks are left, they will send that to you in your benefit every single month. Can't live on that. It's going to cause issues. I hope and pray it doesn't, but for some people, this is why people cry in my office, because they are 65, 63, 67, and it's too late for them. And they have to keep on working because they cannot collect Social Security and they cannot collect Medicare, even though they may think they're entitled to it. Medicare is not free. It's not cheap anywhere in the world. On top of that, what are the immediate ramifications? Forget retirement for a second. It may be 10, 20, 30 years away for you, but you can't get any loans today. If you want to grow your business, Mike will tell you, the bank will say, dude, you're not making any money. I can't give you a loan. So you are restricted also in how fast and how much you may be able to grow. This is why Mike has done great presentations on the Dream Fund that California is doing. And this is why they want you to do your financial analysis, because they want to make sure you're making money. They want to give you $5,000 or $10,000 so that you can make money and pay for the benefits of those who are retiring today. And for you, you can pay into the system so when you retire, you can collect these benefits of Social Security and Medicare. And here's the other challenge. I have mentioned that if you don't have enough benefits in Medicare or in Social Security, you got to have plan B or C. A lot of people think, don't worry, GB, I'll just put money in my own IRA or SEP or something. Well, guess what? You can't. Because to be eligible to put any money in the IRA or a solo 401k or a SEP IRA, any of these plans, you have to have earned income. If you have a 0 Schedule C, or if you have a negative Schedule C, you cannot put money in any of this stuff. So even there now you're limited in having any tax benefit in your own private retirement plan. You gotta have income, earned income. Now, if you have a W-2 job and you have a 401k at your job, or you have some money left over, you may put money in the IRA, but if you are your own boss and you have a negative or a 0 Schedule C, can't put any money in your retirement account. Not to mention, you can't collect any state disability. If you have a job, your employer may be withholding money from your paycheck to pay for state disability. So if you are a female and you are pregnant, you take some time off and your employer doesn't give you any maternity leave, you may be able to collect some disability to replace your income while you are at home with your newborn. There's also the bonding, and even some spouses can take paternity leave. But if you're self-employed, unless you opt voluntarily to pay into the state disability insurance, you got no benefit. So God forbid, if you get hurt or pregnant or have a short-term or long-term disability, you're stuck. Nobody's going to come and rescue you. So these are even short-term or intermediate ramifications of having 0 or negative Schedule C. Watch out for depreciation, because a lot of times people say, you know what, I made money, but I'm going to go buy a car or buy equipment, or GB, write this stuff off. Well, even those can depress your Schedule C, which means you can't secure yourself and you cannot rely on the government to save you if something bad happens. But always keep in mind, if you have some credits on your W-2 from past, present, or future, you may have some saving grace. This is why a lot of times people who are working, they may have a side hustle, or people who are always working, they may have a side job just so that they are limiting their downside should their own enterprise may not work out. So this is why income tax planning and payroll tax planning and retirement planning and financial planning, they all go hand in hand. And if you're not careful, you may end up jeopardizing your present or your future self. Before I go on, any comments, question, any insight, Mike?
Unemployment compensation is not available to those who are sole proprietors. And we found out how big an issue that is during the pandemic. This is why
they had to do the PUA.
But the opportunity always existed and still does for sole proprietors to pay into the unemployment system. Correct. So if you're expecting to get unemployment and you're self-employed, forget about it unless you pay into the unemployment system.
Exactly. And a lot of times people want to get private disability insurance. Even there, they have a minimum threshold. They say, fine, you want to go private and buy your own disability insurance. They want you to make at least a certain amount of net income, because their premiums, just like the state disability, their premiums are based upon how much money you're making. And if you have a very small Schedule C, they're like, you know what, you're not worth it. You're not worth it for us. You're too much risk. We don't want to insure you. So this is why being a boss is tough. You're on your own a lot of the times, and you have to protect your own downside. And during the pandemic, the government, the states with the federal government had to step in and give the benefit of pandemic unemployment assistance to anybody and everybody who didn't opt to pay into it. But this is a challenge. Most Americans, when they complain about taxes, most Americans pay nothing in taxes. Nothing. The top 25% of income earners in this country pay over 90% of all the income tax collected. What you and I pay for the most part are insurance premiums. So we got to pay the government the insurance premiums at 15.3% of our income, or we have to get private insurance on our own. But either way, you have to pay into the system. If you won't, nobody's going to come to rescue you. And that's a scary place to be in, should you find being dealt a bad hand in life. And this is why I always remind my clients, good things happen to bad people and bad things happen to good people every single day. So I'm not trying to preach here. My role as your fiduciary, because you're attending here today, is to save you and help you to decide. I never tell my clients what to do. I'm not telling you what to do. My goal is to just share with you the downsides of certain decisions. When you are an entrepreneur, you are the boss. Be a good boss, especially to yourself. Anything else before I go to the next slide, Mike?
Somebody's asking about sick and family leave credit. Is that something I'm talking about today?
No,
For
we actually did a whole
self-employed?
presentation, but
Okay.
even those benefits can only kick in if you have a positive Schedule C. The government is not going to give you anything if you don't pay in the system. If you are a job holder, as most Americans are, they pay into the system. So if you want sick and family leave, you got to pay into the system. You don't pay, you don't play.
Okay, please continue.
Thank you, sir. So what are the tax implications? Well, maybe you do all this stuff, right? Somebody had brought up earlier, can I collect Social Security and be working? Yes, you can. Depending upon if you are at or below full retirement age, there will be the benefits implication, but either way, there's a tax implication as well. So if you are a single filer, or you are filing separately and such, if you make $34,000 a year, your Social Security benefits and your earned income and your other income, and I'll talk about that in a few seconds, but if you make $34,000 or more, 85% of your Social Security benefit is taxable. So you're going to pay tax on tax. That's how the system works. If you are married, then you make $44,000 as a household, 85% of your Social Security benefits are taxable. If you're single and you make your taxable benefits at $25,000 or more, 50% of your Social Security benefits are taxable. And if you are making $32,000 as a household and you're married, 50% of your Social Security benefits are taxable. Now, where do we get the 32,000, 25,000, 44, and 34? Well, they look at your total income for the year, and to determine whether or not your Social Security is taxable, whatever your Social Security benefits are, single, married, whatever it may be, they take half of your Social Security benefits and they add to it any pensions that you may be receiving, any wages that you may be earning in retirement, any profits that you may be earning, whether it's K1, whether it's Schedule C, whatever it may be, any interest you may be earning from taxable sources, any dividends that you may be earning, and any capital gains. So they take all of that, and if you are within those thresholds up here, your Social Security will be taxable. So if you're planning for retirement and you're planning for your current taxes, and or you are in retirement and you're getting bored and you want to go work, you have to take a look at your entire income portfolio, including Social Security, and determine what is your cost of working in retirement. Because remember, wages are taxed differently than interest, which are taxed differently than dividends, which are taxed differently than capital gains. No income is treated equally. This is why there's always a contention between who's paying how much in taxes and is it fair or not. Each of these incomes, pension, Social Security, interest, dividends, capital gains, they're all taxed very differently in our tax code. And this is why, as you are building your career, as you're building your business, and when you reach retirement, you have to take a look at all of your income sources. If you have all or none or few, to determine what are the tax implications. And keep in mind, your Social Security benefits may be subject to levy. So if you are thinking of working or having other lifestyles in your retirement, you have to be concerned, because if you are working and you have 1099 income and you don't pay your taxes, you don't do estimated taxes, IRS can levy up to 15% of your Social Security benefits if you fall behind on taxes. If you have children and you owe child support because you separated, your Social Security benefits can be levied. Same thing for alimony. So your risk profile also has to be managed in retirement, especially, or if you're eligible to collect Social Security at a younger age, there are implications for you as you live your life. So it's not just easy peasy, it's a lot of consideration. Any questions, comments before I go on, Mike?
One point, when you hit full retirement age, and that, by the way, full retirement age is different depending on when you were born.
Exactly.
The reduction in benefits goes away. Remember earlier
Yes.
on, you said there was reduction in benefits, $2 for every dollar
Yes.
earned over a certain amount. That
Yes.
is eliminated when you hit full retirement age. But it's
Actually,
still
after
subject.
full retirement, you're right, because in the
Right.
in the full retirement year, there's a different threshold that they say, okay, if there's any reduction or not. So you're
Right.
absolutely right. Yes,
Okay, thank you.
absolutely. So that's the thing, though. This is why I always ask Mike for his input, because this stuff is quite expansive and quite complicated. And this is why there are things I can forget to share, and Mike is knowledgeable, so I always welcome his input. So thank you for that, Mike. So somebody had brought up, what if I have a C Corp or an S Corp? Well, if you have non-schedule C self-employment income, you're not subject to self-employment taxes. You're subject to maybe guaranteed payments, or you may be subject to K1. You may be subject to your own your own W-2 from your own entity, which is taxed as an S Corp. You may want to look into private disability insurance, depending upon how much is your partnership income or how much is your reasonable compensation from your S Corp. You may or may not opt into state disability. You may, but God forbid, if you have a high risk because of your genetics or your family history, if you have a high risk of breast cancer or some other medical malady that may pop up, you may want to look into private disability insurance so that, God forbid, if something happens, you can take care of yourself and not worry about paying bills or keeping a roof over your head. Again, I'm not telling you what to do. I'm asking you, I'm requesting you to do your own risk assessment. You may want to opt into state disability. If you are S Corp or partnership or something else, you may want to consider having a solo 401k where you can have your own employee share and you have an employer share. There's different Social Security, Medicare, and income tax implications if you do a solo 401k versus a SEP IRA versus a defined benefit plan. Remember, pensions are no longer in fashion, but they still exist, and they still have great tax planning benefits if you do defined benefit, which is basically your own private pension that you can set up. There are tax and financial consequences, both good and bad, for doing so. You may want to look into real estate. Again, I'm not telling you what to do, but if you are having a negative Schedule C, but maybe it's because of bonus depreciation, maybe because of some other tax planning that you're doing, well, whatever money you're saving in taxes, especially Social Security, Medicare, state and federal income taxes, you may be saving 40% for every dollar you're reducing your line 31 or your Schedule C or your S Corp or partnership income. Let that money go into real estate so you can collect rent, if not Social Security, when you retire. You may want to look at intellectual property, use your brain, use your voice, use your artistic or other people's artistic capabilities to build patents, trademarks, copyrights, other intellectual property so you can collect royalties in retirement. You can look into capital gains. You don't have to remember, Social Security and Medicare, 401ks, IRAs, these are all designed for people who have earned income. If your earned income is less or you're able to reduce the tax impact of your earned income, then my encouragement to you is to roll those tax savings into real estate, intellectual property, capital gains. Let your mind create wealth that you can rely on in retirement. So I don't want you to, I never encourage my clients to rely just on Social Security, just on retirement accounts. They are, and they should be there. But if you want to have a healthy, they all say golden years, right? Social Security and retirement account may only afford you bronze years. But if you want silver years and golden years, you may have to expand your efforts to create the amount of wealth or cash flow to have the golden years. It's not promised to everybody. Remember, according to Social Security Administration, only 5% of the US population retires with enough assets, intellectual, real estate, retirement, capital gains, or business. Only 5% have enough assets to be self-sufficient. 95% are dependent in some fraction on somebody. And unfortunately, 60 to 70% of the US population relies on multiple sources in retirement to survive. My encouragement, my prayer for you, all of you, and for my clients is that you don't find yourself in that position. So even beyond the Social Security, beyond the Medicare, beyond the 401k SEP and defined benefit, you may want to look into other things so that you can assure or put the odds in your favor to have a healthy retirement. Before I go on, anything you want to add to that, Mike? I know we're running close to 2 p.m. already.
No, yeah, please keep going then. We're good.
Other considerations. So if you are thinking of relying partially or fully on Social Security and you had government pension, there are windfall eliminations of Social Security benefits if you have government pension. If you have government pension and you're receiving or you expect to receive Social Security spousal benefit, there's a government pension offset. There's a whole complicated rules there that you may want to work with a financial advisor or an advisor at SBDC. So you are thinking of these things because you're getting close to retirement, or you think you're far away, but you want to take care of your future self while you can today. There are benefits for people who are widowed, male or female. There are different benefits that you can qualify for at the age of 60. And if you happen to be disabled at the age of 50, so that can have benefit and tax implications for you in short-term and long-term. There are benefits available for divorced spouses. And if you are divorced and or you have a living spouse, you're now widowed, you may have some 50% benefit that you may be entitled to. So all of these things, I'm just throwing nuggets at you so that you know what you may be eligible for. So as you work with the SBDC advisor and or your accountant and or your financial advisor, you know what to ask for. So I'm not going deeper into these things. There's a whole presentation just around these topics, but be aware of what you may be entitled to now or in the future. Now, since 2015 or 16, I believe, same-sex couples can also benefit for the benefits I just mentioned earlier, if you're widowed or divorced and so on and so forth. If you have children or if you are a child and you are around the age of 19 or below or 18 or below, there are different qualifications. You may have Social Security benefits under some circumstances. You may have military benefits. So how that interacts with Social Security, you may want to be aware of that because you may have served your nation and now you've been working for somebody else or now starting a business of your own. All of these benefits may interact or contradict each other at times. Also, you don't have to reach an old, ripe age to collect Social Security. Sometimes life gives you a blow and you are knocked down because of a medical condition. So you may be able to collect Social Security benefits and or Medicare benefits. And there are different qualifications if you're below the age of 24 to 31, at 31 or later. So you may know somebody, or God forbid something happens to you. Kidney failure is a qualifying medical condition. So is cancer, heart failure. I mean, Social Security Administration has a long list of qualifying conditions. You may need some help temporarily or permanently because life has been unfair to you or your loved one. Be aware of that. But my point today has been that you have to plan for your today with tomorrow in mind. Don't go for just a negative or a zero schedule fee, because you may be sabotaging a time in your life, which I'm hoping pray never happens, when you may not be able to work, or you may get to a point where you no longer want to work. Keep that horizon in mind as you navigate your today. Anything you would like to add to that, Mike?
No, it's a great presentation. For those of you who want more information or need help with your businesses, as always, the best thing for you to do is to make an appointment with an SBDC advisor. If there's an issue that the SBDC advisor for which GB is more suited to answer, we will refer you to GB, because GB is also an SBDC advisor.
We have some good advisors.
Yeah, we have excellent advisors.
We do.
Thank you, everybody, for your time. Thank you, Sadie, and we'll see you this time next week. There is a
Yes, sir.
YouTube channel that has recordings, GB. Now, I don't know if you know that, but you're now a
Oh, I did
star.
not know that.
Yeah, you're a star
Cool.
now on YouTube.
I want to collect royalty income.
I put the link in the chat room. And so thank you so much, and we'll see you next week.
Thank
Bye,
you very
everybody.
much. Bye. Thank you, Sadie. Thank you, Mike.